Welcome, ladies and gentlemen. Definitely glad to have you back to the Freedom Team Apex Marketing Group channel. So, what we're going to talk about today is how to protect your income, how to have a legacy, pretty much how to make for sure that you have life insurance and why you should have that. So, before I get started, real quick, for some of you all that do not know, make for sure, I be forgetting where it's at, right? Make sure you hit the subscribe button up, down, to the left, or to the right. Make sure you like and definitely hit, of course, the bell so we can make for sure that you get all the new announcements coming out. Now, for the people that don't know who I am, my name is Fahim Muhammad, the Freedom Coach. I am a chartered senior financial planner. I am a licensed mortgage broker, real estate broker, licensed investment and insurance broker, and the business owner of the Freedom Team Apex Marketing Group. I am an international speaker, mentor, coach, and trainer, and also author of the highly acclaimed book, Making It Happen from Zero to Hero. So, let's get started. So what we want to talk about real quick is, of course, this is huge. Why you want to protect your income, why you want to be able to set up a legacy. One of the things that we really miss and don't understand, some people rather pay $200, $300, $400 for a pair of shoes and do not have the right income protection insurance to protect their family. So just want to share a few key things with you. So as we start off the new month, the new week, the new year, the new day, you can understand why it's imperative, one, for you to be a professional, hire a professional, get professional results. So that's why below you can give me comments, you can email us back, or click on the links to follow us and to let us know so we can put you either with us or one of our particular professionals to help you. So let's get it. All right, here we go. Let's talk about life insurance, right? So we're going to talk about, and life insurance is huge. It's one of the main things that you use, obviously, to help secure your financial future. This is how and why. Without life insurance, so let's talk about what to choose. That you die and your family grieve. Now, let me say a disclaimer. Nothing can replace a loved one. Not no money, not a thing, no car. So let's give me that disclaimer. But it's a part of life, of course, that we live, and obviously that we go on to the afterlife or whatever that you call it. But also it's serious that when you leave, then there's certain things that the family still have to continue. So you want to make for sure that certain things are in place. So I just want to make sure I give that disclaimer. So now we're talking from a financial perspective point of view. Family must find a way to bury you. That's a challenge that you have without life insurance. Family must find a way to pay off your debt, your mortgage, your car note, etc. And then by not having life insurance, ladies and gentlemen, family must take on more debt to help solve more debt. Okay? Wow. And then number 6, family is sad. Okay? Because nothing can replace that. All right. So now we're looking at with life insurance, pretty much going to solve a lot of these things, and you just decide. You still die and your family still grieves and wish you was here and want you here. No question. Number 2, family has money to bury you and to pay off debt. But this one, I'm telling you, is so huge. It's probably the top thing. Family can focus on grieving. They have nothing to worry about financially, and they can make efforts to try to put the pieces together. Ladies and gentlemen, you cannot beat this with a ball in the back. Which one you think you prefer to have? Leave your children, your husband or wife, your mother, father in this situation, or would you prefer better to leave them in this situation for the same cause that you're paying for Jordans and jewelry and all those things that now you can take care of your family? Which one, seriously, you prefer to do? And I already know, ladies and gentlemen, you prefer to obviously have it. So, with saying that, we want to basically just educate you as we close out. It's really two types of insurance, with a lot of different, quote, levels, brands within there. And I'm going to show you how it works. So let's get ready to take care of that. This is important. So make for sure that you have your pen and paper on this, ladies and gentlemen. This is a big deal. You don't want to miss this. All right. So When you have, so basically to make, I'm gonna do it simplicity, with simplicity for the time we have. So what happens is, it's pretty much only two types of life insurance with a lot of different names within them. You have what is called cash value life insurance, and you have what is called term. Okay? All right. And so one thing I want to share with you, some of the top other financial course trainers, teachers, presenters, other than myself, other than the Freedom Coach. You got Susie Orman. You got Dave Ramsey. You got the author of Rich Dad Poor Dad, Robert Kiyosaki. Ladies and gentlemen, what I want to share with you is this, is that insurance is not for investment. It is for protection of your income and to protect your assets for your family. It is not for you to use as an investment, because it is something that's set up that if something happened to you prematurely in the future, not now. So just want to share with you real quick. You got cash value. You got something that's called whole life. Okay. You got something called universal life. You got something that's a U. You got something called variable life. And you got all these other names. So the term, pretty much, you got what we call lid term. I probably should have wrote that other way. Lid. Yeah, I probably write it this way. Okay. Probably want to write this lid. Okay. Yeah. Now, so let me explain and just break this down. Pretty much with cash value insurance, and we're going to mainly focus on the one that majority of people have, which is a whole life. Okay. Basically, with cash value life insurance, they tell you that you have three things, which is true. What they don't share with you, you can only exercise one at a time. They let you know that you have a life insurance coverage, true. They let you know that it may accumulate cash value, it's true. They let you know that you can borrow from it. All three of those things are true. But the thing that we share and educate people, you cannot exercise all three of them at one time, and it costs more, which means you get a less amount of protection. Okay, so that's how cash value. And then you have universal that can have, quote, some saving other vehicles and tax saving vehicles, but still in most of the policies, not all the cash values, but in most of them, you have to borrow your money. Ladies and gentlemen, let me stop the press. Okay, if you have to borrow it, do you own it? That's all I'm saying. If you have to borrow, you don't. Ladies and gentlemen, all companies that market those are very good companies, and they will pay the death claim. It is the strategy and the product that they're offering you as this not fully sound. So what we believe in is term insurance. And I know they tell you that obviously term goes up every year. Ladies and gentlemen, let me share with you, term withstands exactly for what it is. Term is for a period of time. But we want to educate you and share with you, ladies and gentlemen, it's the same way you buy everything, all other insurance. Your car insurance, guess what that is? Term. Guess what your health insurance is? Term. Guess what your homeowner's insurance? Term. You pay strictly term insurance for a period of time. You pay strictly for the coverage. If your car insurance say, hey, you know something, we want to go up on your car insurance next month, an extra $50, because we want to take $50 from you, and we want to keep it for the first 2 or 3 years, and then we're going to charge you to borrow your own money and give you a less rate of return than we're giving you. Are you kidding me? Are you kidding me? Ladies and gentlemen, term stands for a period of time. What happens is they have term that goes anywhere from 1 year, which is annual renewable term. Then they got term, of course, for 5 years, 10 years, 15 years, 20 years, 30 years. And some companies have even over 30 years. Ladies and gentlemen, what I want to share with you, that the longer you get the term, of course, is better, and it's based on your age. So obviously, if you're 60, you're not going to be able to get a 30-year policy, where if somebody was 50, they would, okay? So let's just share with this. So pretty much the main three type of term, the L stands for level, the I stands for increasing, and the D stands for decreasing term, okay? All right, so level means it stays the same. It depending on what you're doing is why you want to get it. But normally, level is the most important one that you want to get, the level term. Increasing term, because it's something called inflation. So what the dollar is today may not be worth the same dollar in the future. So if you hypothetically got a $250,000 policy this year, but if 20 years later, that same $250,000 is not the same. So you may have either what we call an inflation rider or an increasing benefit rider on your term to make sure you keep it with inflation, but you don't have to. Then decreasing term. When would you use a decreasing term? You may have a level term policy to protect your income and all the other things, but decreasing term, you may have an additional policy that as you pay off your debt, for example, your mortgage, if you start out with a $100,000 mortgage, and for the sake of example, we know these are not the exact numbers, but follow me for illustration purposes. If you happen to have a $100,000 mortgage, and we're going to say in 15 years, in 15 years, now your mortgage is down to $90,000. So what happens is, as your debt decreases, guess what happened with the insurance to cover that debt? It decreases as well. Ladies and gentlemen, I'm telling you beyond a shadow of a doubt, you don't believe me, you can listen to Susie Orman, Dave Ramsey, Robert Kiyosaki, the author of Rich Dad Poor Dad, the Freedom Coach, and myself. You want to be a professional, hire professional, get professional results. Ladies and gentlemen, the reason why you want to get term insurance, seriously, number one, is no trick, it's no frills, there's no thrills. It's strictly for protecting your income. We believe in what is called a split funding concept, or better yet, better known as buy term investor difference, or let's go back to great grandma. Do not put all your eggs in one basket. Okay? So when you have, let me erase this and just give a last example. Ladies and gentlemen, we got to stop buying liabilities. We got to start getting assets. We have to start getting things to protect our income. So ladies and gentlemen, let me break it down for you. You don't want to put all your eggs in one basket. So here we go right here. Here, this is a whole life, okay, cash value policy, okay? This is a split funding, okay, or better known as BTID, okay? Where over here, you're not putting all your eggs in one basket. Let me break it down. So what happens is, with a cash value that you're paying, for the sake of example, we're saying you're age 25 and you're spending $50 a month, okay? You have a $75,000 policy, okay? And you have cash value that's accumulating in here. So you say you start at age 25 and say at age 65, hypothetically, it grows to $37,000. So ladies and gentlemen, let me stop. $37,000 is not enough to retire now. There's no way mathematically you're going to be able to retire 30 years from now. If you follow me on that, make sure you write that down. This is what I'm telling you right now. I'm going to give you this last 2 tips before we go. Make sure you stay to the end because this is going to be important. This is something that could truly change your family life. So make for sure, where that button at, make sure you zoom in on this, that you can press up. You can press down. You can either to the left or the right. You can subscribe and make for sure you like it and hit the bell. All right. So let me give you these last 2 things as we close out. So what happens is that people believe that if they die, or when they die rather, they think they get the $37,000 of cash in here, and they get the $7,000 what is called face amount. Okay, and that's incorrect. You only get one or the other. So what happened is they actually take the $37,000 to help fund the 75. So they really only paying what, about $40,000 or so with that. Ladies and gentlemen, let me show you this in closing. The split funding concept by term investor difference. First of all, we're not going to play any games. We're going to do what great grandma say. Don't put all your eggs in one basket. We're going to get you a term policy, a 30-year term, and this is the concept. It's something called the theory of decreasing responsibility that says real simple that when you're 25, 30, 35, 40, that you have children, you have debt, you have bills. By the time you get 60, 65 to 70, your responsibility is decreased and you're an empty nester. So you don't need the same amount of insurance because you are getting older. You still may need some. But for sure, the older you get, you're going to need some cash. You cannot go to the grocery store, ladies and gentlemen, with your term policy or even a cash value. Ladies and gentlemen, you're going to need some cash. So what we're going to show you that if with this over here costs $50, we want to show you over here with your split funding, you take $50, and now with the term, it's only going to cost you $23. Now you have $27. Ladies and gentlemen, we are talking about that now if you're getting a 6% return, we're talking about 8%, or hypothetically even a 10%. We want to show you in that same 25-year period to age 65 that at a 10% return, you can have $156,000. And guess what? If something were to happen, you get both. You get the 156 and the 75, and the reason why, because it's split. One is not contradictory or working with the other. You have the 75,000 strictly for the term to take care of your 30 years, and if something were to happen, then your family get the money in your separate account. Ladies and gentlemen, even if you believe that annuities are risky, even if you believe investing in mutual funds is risky, if you already, well, from one, it's really risky not to invest, period. But if you already putting your money in the bank, you still will win by taking the difference and saving it in a separate account. Ladies and gentlemen, just want to share with you, this is how you play this money game to win. It's not, quote, what you know is what you don't know that's getting you. So, ladies and gentlemen, as I get ready to close, just want to share with you, this is how you want to set up your insurance. Now, the bonus thing, this is the one bonus thing, and this is why people always love to get on our channel, because I always give more than people are asking for. What I want to close is this. Basically, the rule of thumb is real simple. It's mathematical formulas we can use, but the rule of thumb is you normally take your income and multiply it times 10 to 12 times the amount to get an idea of how much coverage that you truly need to protect your family. Now, to give you a quick itemization and somewhere to show you how we figure that, it's called the dime theory. Ladies and gentlemen, here we get ready to go to close out. The D stands for death. The I stands for income, M stands for mortgage and debt, and the E stands for education. Because these are the things, as I talked about in the beginning, remember I said when you don't have them in place, something happened, your family got the debt to deal with, then they got to take out debt to deal with the debt. We want to show you by how you can have the proper plan, how you make this thing happen. So the D is, we want to show you for the death, you basically need about $25,000 right now. You know, that's for everything. That ain't just, that's for the burial, the funeral arrangements, the whole kit and caboodle about that, okay? The income, you take whatever income you're making and you multiply it times 10. Let's say you're making a $50,000 a year income. So that right there will give you $500,000 that you need. Now, if you happen to have a mortgage, you put that on there. If you don't, you don't write it on there. But say you got a mortgage and you got a $200,000 mortgage, okay? Now, say you got debt, okay? Say your debt is basically about, say, $50,000 that you got in debt, okay? The next thing, let's talk about education for children. Children now is taking 4 to 5 years for them to be able to graduate from college, go to trade school, start a business, whatever you're looking for them to do. That's $250,000 per child. Right now, we're going to say you just got one child, okay? You got one child. Now let's add it up. This is the income that you need, ladies and gentlemen. You're looking at, let's go. We got 500,000 plus 200,000, which is 7. We got 8, 900,000. We got 1 million. We got 1 million and 5. Look like 1,050,000. We got 1 million and what's that? 50,000. And make sure I get my numbers right, right? Yes, 1 million and I think one of them zeros got to go. Yeah. That's it. Yeah, we got. Yes, you got 1 million. Let me make it look real good, right? All right, so, yeah, bam. You need 1 million, basically 1 million in coverage to take care of your family. Ladies and gentlemen, the best thing that's going to be the cheapest thing you do is to split fund it because it'll allow you to get the max amount of coverage for the least amount of money. So, we want to make for sure that, obviously, if you like it, comment below. You can make sure you can get some supported information that we normally have below. And so what I tell you right now, either, where that subscribe button at? It's either, make sure you zoom in on this one, right? Either it's up, down, to the left or right. Make for sure you hit the subscribe button. Let us know how you like it. If it benefit you and your family. And again, you can hit the like button and hit the bell. And as I close, as I say all the time, good things come to those who wait, but only what's left over from those who hustle. My name is Fahim Muhammad, the Freedom Coach, the master of increasing your cash flow. Hey, free yourself and your dreams will follow. You have a good one.